Hi, my name's Yuriy. I'm a Maths PhD student at Imperial College London, as well as a tutor at the Elite Prep. This video is going to be part 2 of the series where I introduce the concept of option pricing and its fundamentals. In today's video, we're going to start off by tackling the exercise which was introduced at the end of the previous video, so if you haven't seen that, then take a look. But I'll give a brief introduction to it anyway. So in the previous video, I introduced a situation where we have a market which includes a stock and the money market account. So this stock can be anything. It can be just some equity. And we say that the stock moves up with probability P and moves down with probability Q. We say the stock starts at time 1 as S0 and at time 2, because we have two probabilities, we can think of this as throwing heads or tails in a coin, heads with probability P, tails probability Q. And we get S1H, so the price of the stock at time 1 if heads is thrown, to be equal to US0 and S1T to be equal to DS0. In addition to this, we're also going to have a riskless asset which starts with price B0. We're actually going to say B0 is equal to 1, and it goes to 1 plus R B0, which is equal to B1. R here is just the risk-free interest rate. Finally, we have a derivative which we want to price, and that derivative is a function of the underlying asset, i.e. the equity. Because it is a function of the underlying asset, we can just redraw the same diagram as above, but for our derivative, which we will call y. And we will call the payoff y1 of S1H equal to YH, and similarly y1 of S1T to be equal to YT. And what we want to get is the price at time 0 of y1. So y1 at time 1 is the payoff of the derivative, and y0 at time 0 is its price. This is the amount for which we'll want to sell or buy the derivative for. Great. So far we have these values P and Q. These values are going to be called the market measure. So up until now, I've been talking about some imaginary coin which we're throwing and then deciding on the price of the stock after some amount of time. We're going to denote this imaginary coin as omega, and omega can be heads or tails. Up until now, we have had the probability of omega equal to heads equals to P, and the probability of omega equal to tails is equal to Q. And so because P and Q have to sum to 1, and P, Q are strictly greater than 0, this is a valid probability measure, and we call this the market measure. In short, the market measure dictates exactly what is happening in the market. Here, of course, it's just a binomial model, so it's not really representative of real life, but the market measure is exactly what is happening in our underlying predictive model of the market. There is also another measure. That other measure is called the risk-neutral measure. And the risk-neutral measure is a measure which is equivalent to the market measure, i.e. Any event which is possible in the market measure is also possible in the risk neutral measure, and vice versa. In other words, if we have the probability that omega is equal to heads is greater than 0 in the market measure, that happens if and only if the probability, and I'm going to note the risk neutral measure with a p tilde, the probability under the risk neutral measure of heads happening is greater than 0. And the same thing for tails. So probability of omega equal tails greater than 0 if and only if probability of omega equals tails being greater than 0 in the risk neutral measure. The second important property of the risk neutral measure is that the expected value of any simple asset under the risk neutral measure is equal to the increase by interest-free rate. I'll just give an example, and for now this is all in the simple case of the one-period binomial model. The risk neutral measure becomes a little bit more complicated in more general cases, but we're going to cover that as well in another lesson. Okay, so going back to our simple assets, the simple assets being the ones which the market is comprised from without the derivative, we want that the expected value under the risk neutral measure of S1 is equal to 1 plus r of S0, and the expected value of B1 is equal to 1 plus r B0. In other words, all the assets increase at the same rate on average. Just to recall, the expected value on a discrete probability space, so if we have some random variable z, is just equal to all possible values of x in our probability space, probability that omega is equal to x, and then also z of omega. So in our case, if we look at S1, the expected value of S1 is equal to either probability of omega being heads times S1 of heads plus probability of omega being tails times S1 of tails, which is equal to PU S0 plus QD S0, which is equal to PU plus QD S0. So clearly our market measure gives us an expectation of PU plus QD S0. This is not necessarily equal to 1 plus R S0, and actually depends on the specific choice of P and Q. Obviously, the expectation of B1 does give us what we want, but this already isn't the risk neutral measure. So that was just a quick detour into the risk neutral measure. We're now going to return to pricing this Y0 and get some interesting result at the end. So I'm going to do the same approach as was done in the previous video, and I am going to write a set of simultaneous equations for Y0. So we, as before, want to find a trading strategy which replicates the payoff of Y1. Y1 has a payoff of YH when we throw heads, and Y1 has a payoff of YT when we throw tails. So YH should be equal to some combination of stock and some combination of investment in our money market account, just in a bank account. Again, I'm going to say delta and x are just equal to some real values. They can be positive or negative. And we have this is equal to delta S1 plus x B1 evaluated at h. B1h is just deterministic and it's equal to 1 plus r B0. S1h is equal to US0. So this is just equal to delta US0 plus x B0 1 plus r. Yt is similarly equal to delta S1t plus x B1t delta ds0 plus x B0 1 plus r. And now we just want to solve these simultaneous equations. So we have then the value of YH in terms of the stock and the initial investment in the money market account at time 1. So we have Y1 is equal to delta S1 plus x B1. So that implies that Y0 is equal to delta S0 plus x B0. And therefore, by plugging in the values above, we have Y0 is equal to, and then after some rearrangement, we actually get the following. And from this equation, we can actually define this as P tilde, this is Q tilde. In the beginning, at the end of the previous video, we also gave the requirements that D is less than 1 plus R is less than U. This is required so that there doesn't exist an arbitrage in the market, and you can actually show this by similar examples that we did last time. Then, because of this, we actually have that P tilde and Q tilde are both greater than 0. P tilde plus Q tilde is equal to 1, so it defines a valid probability measure on our space of heads and tails. And actually what we can see is that the combination of P tilde and Q tilde is just equal to the risk neutral measure of our space. This can be calculated in a second, and I will do that. But for now, just accept that this is a risk neutral measure. The conclusion here is that Y0 is just equal to 1 over 1 plus R and times the expected value under the risk neutral measure of Y1. This is just another way of rewriting the above. So the two stars are just equal. It turns out that this actually is more generic and it can be extended to more complicated situations than a binomial model. So you can extend this to a multi-period binomial model and even continuous time, continuous space case. We may tackle that in a future video if that is of interest. Now is also a good time to introduce two important theorems in the theory of option pricing. The first one is called the fundamental theorem of asset pricing, and it states that there is no arbitrage in a market if and only if there exists a risk neutral measure. The second theorem, which I want to introduce, is the following. It's a fundamental theorem of asset pricing too, and it states that if there exists a unique risk-neutral measure. That happens if and only if the market is arbitrage free and complete. So we have already discussed what it means when a market is arbitrage free. A market is complete if any derivative can be replicated as a combination of our simple products. So our simple products in this case were just one stock and the money market, and we were able for any derivative to find a combination of those stocks in one period, which would replicate the payoff of the derivative. A market is complete if we can do that for every derivative. So implicitly in the simple model, we've shown that. In the simple binomial model with one period, we've shown that it is complete because we are always able to find a trading strategy which is self-financing and it replicates the payoff of our derivative. What we've also done is shown that if there is no arbitrage in our binomial market, i.e. we have these conditions of D less than 1 plus R less than U, then we have actually found a risk-neutral measure. I'm going to prove this. I'm going to prove that this measure P tilde Q tilde is actually risk-neutral. So remember that the risk-neutral measure required us to have a measure which is equivalent to our market measure. Our market measure was probability of omega equals heads equals P, and probability omega equals tails equals Q. P, Q are both greater than 0. Well, if we look here, we have P tilde is greater than 0 and Q tilde greater than 0. So that means P tilde is equivalent. And equivalent here is mathematical notation for the probability measures being non-zero on the same sets or the same elements. And the next step is that we want the expected value under E tilde to be equal to 1 plus R S0 for the stock, and also E tilde to be equal to 1 plus R B0 for the investment in the bank account. E tilde S1 is equal to P tilde S1 of H plus Q tilde S1 of T. That's by definition of expectation, which we defined above, because P tilde omega equals to H is equal to P tilde, and P tilde omega equals to T is equal to Q tilde. And this can be calculated by substituting in the values above. So we have shown that S1 under the risk-neutral measure increases on average just like the risk-free interest rate. For the bank account, this is immediate because the bank account has a deterministic return rate, so B1 is just equal to the expected value of 1 plus R B0, and that's just equal to 1 plus R of B0 because 1 plus R B0 is a constant. So we've shown that P tilde is a risk-neutral measure. Well, what we've shown in a simple case is the following theorem. Given a derivative with payoff y1, the price of the derivative in the one period binomial model is equal to the discounted expected value of its payoff. So in other words, we just have y0 is equal to 1 over 1 plus r, expected value under risk neutral measure. In future videos, we are going to extend this theorem to the following more general case. So the general case is that we have a derivative and we have now a multiple stage process, and we have multiple times. So rather than just having time 0 and time 1, we have times 0 through to time t. And we want to price a derivative which has a payoff of yt. To do that, we can just compute. So to price it at the time little t, we just need to look at the expected value under the risk neutral measure of yt dt conditioned on all of the information up until t. And all of that will be made clear in the future. So actually the discounted value of yt is equal to yt dt at t. In order to cover that, we're going to need to cover martingales and also filtrations. And these will be done in the next video. So that's everything for today. I hope it was useful, and thank you for watching.